Hi, everyone. Simon, Richard, Sinatra, Stephen. How's everyone doing? Hello, Ryan. How's it going, buddy?
Morning, Dale. How are you?
Doing pretty good. Just would like to, I think I'd like to talk old resistance at the double top.
Yep.
Prior to the intervention. Were they checking rates or anything last night, Ryan? Or came in? Nothing at all?
Been very quiet. Usual comments from the usual suspects, Suzuki and whatnot. Watching. But no, nothing.
Okay.
This is exactly what they want. They want the vol sucked out of it, and they've done that.
Okay. Same with cable.
Yeah,
Anything
cable has taken the vol out as well. I think yesterday Bailey did the right thing in the end.
By not really commenting too much on it, or okay.
No action. You know, the market and the UK press was the one having the hissy fit. And he gave it a big, well, we're watching and we'll just carry on as normal. So get over yourselves.
Okay, you didn't listen to Steve Volke either. I could understand him not listening to the other people. You know what I mean? Steve, if you're here.
No comment.
All right, I mean, you solved it right away. So crazy action in metals yesterday. I had that guest from Macrodesiac, Tim Valance, yesterday.
Did you hear my name, Dale?
Oh yeah, that the BOE governor didn't listen to you about raising rates.
Yeah, that's.
I said I could understand him not listening to people within his government, but ignoring your solution.
That's going to be unfortunate for them. My assumption is that they're going to end up having to do it under worse circumstances than doing it. It's better doing it earlier than later, in my opinion. But
Yeah. Well, that's why you're a successful entrepreneur and not.
Just imagine, even Danny Blanchflower is now in favor of them raising 100 basis points.
I didn't know that.
Yep.
Don't listen to. Let me give you a lesson. Don't listen to former old central bankers and.
No. That is actually important, Ryan, because he's even as an ex. Member, he has remained uber dovish. Dovish.
I'll explain why I say that. We had the ex-deputy governor of the Bank of England, Charlie Bean, out this morning on the radio, moaning about the Bank of England should have gone big or gone home, and then he went on to comment that because of the inaction, UK 10-year yields are higher than Italy and Greece, which was absolute bollocks by about 50 basis points. So that's why we don't listen to former people.
Speaking of which, it makes no sense anybody comparing Italian and Greek yields with UK yields, because I think practically the only activity in Greek yields, for example, is from the ECB, more or less, right, at a big extent. So, I mean, Greek yields are completely artificially created.
Yeah.
Okay. Yesterday Tim said, Tim said, shorten your time horizons. He talked about Ray Dalio, who pretty good money manager, and he said he can't see out. He used to like to position himself for what he saw at least 6 months out, or at the minimum, and he can't do that. So, one perfect example, when we started the broadcast yesterday, silver hit this 1850 level right here, and it was a good buy for a day trade, right? Yeah. So, I mean, it was 50 cents, but, if you were sitting thinking it was going to turn out to be the major turn, you gave it all back. And you got stopped out, and now it's higher than when you originally got in. So, that really, to me, drives home the importance of taking partial profits in this environment more than prior, because of, how markets chop and not follow through.
For me, that's another example why I'm so happy I'm not a day trader, right? Because all this, in my opinion, is purely noise, and I really don't want to get caught up in that noise.
Okay, so
Slice and dice,
all right,
Dale. Slice and dice.
huh? Well,
Slice and
yeah,
dice, Dale. We call it slice and dice.
yeah.
Get
So
in, take it up, leave your stops.
all right, so long-term thinking, I think we know what it is. You know, we've entered a protracted bear market in equities. That's your view. Where are there other opportunities where you could be thinking long-term, Steve, and maybe take advantage of the direction the markets have been going in and may continue to go in? You still think there will be a time? I know you've been negative the metals for, you know, a few months. You talked about this. Are there levels where you would even start considering physical buys?
I prefer to do a top-down analysis, right? And meaning that before I start considering, for example, buying the metals, more important than the levels, although there is an exception with silver. Gold is not so much the case because it's still in, you know, rather decent levels. But silver is not far away from levels that would be unsustainable, right? For reasons we've
You
explained
mean
before.
under production?
Yeah, exactly.
Costs?
In
Okay.
my opinion, anything below 16
18.
worst,
Okay,
yeah,
16.
anything below 16 is a no-brainer. Really, it's, you know, you don't look at you don't
You don't try and time it. You just
yeah,
buy
you
it.
just buy it. You know, if you get these type of levels in silver, in my opinion, and for my trading style, you just buy it. End of story, right? But in general, with the exception of silver, because it's trading so close to levels that, in my opinion, you just buy it and don't even think about it. I first want to see a macro shift before I even consider a change in theme. And by a change in theme, meaning equities finding a bottom, the dollar finding a top, metals finding a bottom, so on and so forth.
So it's still all one market. They're still all going to go
Yes.
in one direction.
Yes.
Okay, there's not going to be any differentiation. So really, if
but
you're looking for,
people should realize that there is one market at the moment, and it is the exact opposite market from what we've had for so many years, because we have the exact opposite type of policies. Instead of expansionary monetary policy, we have contractionary monetary policy. We have high inflation, which prohibits a quick shift from this new, policy era to the other one. Yeah, from this regime to the previous one. That's something that cannot happen in a blink of an eye. We have to see a lot worse things happening in the financial markets and the global economy before they can capitulate. So everything that was being built on cheap money, euphoria, monetary policies and fiscal policies that were, literally in the limit of, madness, is now unraveling, right? And for a good reason. So as we were staying the course with the previous policies, I think that people should stay the course with the current policies and not fight central banks.
Okay. Looking at copper, S&Ps have taken out the lows, the June lows, and we know what's happened to the precious metals. And I'm not saying this is the beginning of a bull market, but copper has shown some pretty good relative strength, holding, its July low.
And good morning,
hey,
Coach.
Blake.
Good morning.
Yeah.
Hey, I don't know if you guys noticed this either. Copper, sentiment's been pretty sour.
Blake, you got to show the DSI. I've never seen, or you may not be able to show it, but
no,
you need to.
I'll show people.
Have you ever seen numbers like this on the DSI ever in your career?
No.
In so many instruments.
No, and so what I'm going to do really quick, and let me go ahead.
Just to put things in context having to do with copper has practically lost 40% of its value since spring, right? So it's already quite a massive move to the downside within a matter of just a few months,
and
right?
for good reason. I mean,
of course,
China's slowing down. The global economy is slowing down. China's really slowing down. One of the things that I think
back to $4.
Well, one of the things that I think goes people forget about is that China is still in this zero COVID policy, right?
Yeah.
When the hell are they going to come out of that? I mean,
that's a good question.
But they keep reporting that there's like no. I mean, when will activity pick up again, and what kind of bearing will it have on the global economy? But take a look at copper. So there's the DSI right through here. Let me go ahead and grab a pen.
Copper 14.
Yeah,
but the amazing I've never seen the S&P at 5. Have you?
I think we've seen that before. It was actually the what's really interesting is the dollar is at 94, but it was at 97 yesterday, which was crazy. The dollar actually continued higher, and we sentiment actually eased off. But those are numbers that are pretty staggering and very excessive. So
silver's still overbought. There's it's way up at 22.
Yeah, the problem with the markets right now is that we're so, here's the S&P. Let's go, and I'll just pull it up on a daily chart. We're so oversold. We're matching these lows, and I think while we're above these lows, that 3640, 3650 level, you're going to have people that are just looking at it from a risk reward perspective. I think stocks are going to eventually break down. I just don't know if they're going to break down here this week. After such a big drop. I mean, I would not be surprised to see it bounce back to like 3,900 before we eventually fail. So I would be very nervous about trying to play a breakdown here because the risk reward's just not there. But like I said, I'm not bullish. I just think that there's a good chance of a bounce. You look at some of these extended moves, whether you're talking about the dollar, you're talking about precious metals, you're talking about crude oil. I just posted a chart on crude. We finished this bullish bat. I think that's a pretty good close extension of because you could say that's a 78% retracement of this entire move. So I mean, you start looking at the gold dollar extending to the top of its range, top of its channel. You've got let's go roll over. Yeah, I mean, it could be a throw over there of the channel. That's a risk. And what else did I want to show you? Let's go into really quick. You look at precious metals. Gold is completed an also equal leg move. And it's struggling to go down here, and silver's not even hitting new lows, which I think is rather interesting. So I don't know. I would be very nervous about trying to chase the markets lower. There's another thing, and is Kman here?
I'm here. Good morning, everybody.
Hey, good morning,
Kman.
Hey, so I don't know if you saw that I posted this in our ForexAnalytix chat room, but did you notice the dollar rand, which has been really kind of like the emerging market currency that's been super weak during this whole move, and it's been taking the market. I mean, this has kind of been almost like a lead indicator to the stock market moving down. We're actually seeing now on a candlestick formation, just FYI, if we close here today, doesn't mean we're going to, it's just if we close here today like this, that's dark cloud cover, 161% extension of the last move lower, 78% retracement of the post-COVID drop. So you got a 78% retracement, which argues, if you ask me, precious metals, I'm sorry. These emerging markets might be in more of a consolidation, which makes sense, following, what we've just seen in the global markets. So if you have an emerging market currency like the rand starting to come back down again, that means it's strengthening. That would also argue that stocks might find some support here. Have you seen this rand, and what do you think of it?
Yeah, I think we were talking about these levels just above 18, right? We capped there for now. I think It's a term people like to use, the turnaround Tuesday. It does look like yesterday, after the violent move in Asia as well, we have found some sort of stability.
Yeah.
And I'm slightly positioned in that way via Aussie and a bit of Kiwi. But I think we have to really be careful going into the end of month, to be too early to call the end of the
We
end
have end of
the
month and a
rally, you know.
quarter.
I mean, I'm
Yeah.
always trying to be cautious. Today, I'm looking at the yields. I'm also seeing the 10-year yields having gone really close to 4%, which is a bit of a retracement level in the ultra long term compared to the Volcker and the pandemic lows. I would say that on the day there's a fair chance that we see a bit of a corrective, more positive risk environment. Just looking at the dollar yields coming off and the rest of the yield sphere cooling down a little bit. So yeah, I can see it all do some form of corrections.
That's really, it's interesting. I'm glad you pointed that out. So this is the 10-year, this is the 10-year bond market. So it's going to be the inverse of yields. That's the 2007 low, right? That's the pandemic. I'm sorry, the GFC. Basically, before the GFC, everybody went a flight to safety in bonds. That was the low to the high in 2020. COVID. Post-COVID high. We're at the 78% retracement right now. That's a pretty massive retracement to be stopping at, which is great observation, Kman, and you can see there's your yield at 4%. So, what if? And I'm not. I don't know if this is the end of, this is the stock market bottom and this is the top for yields, but I would think from a risk reward perspective, this is where people stop pressing the market, at least near term, until you have more evidence of what's going to happen. Those are my thoughts. Now we haven't heard from Stelios. So is he here this morning?
Nope. Good morning.
Okay, good. Let's
Good morning.
continue moving on.
How are we doing?
So Greg is here. Oh, you are here, Stelios.
I am. Yeah.
Yeah. Oh, just kidding.
I agree with what Steve said, by the way, about metals and me. And I actually must say, I'm very surprised at how well cryptos are bouncing.
They were holding up yesterday really well.
Yes.
Yeah, they were.
Yesterday was the clue that today obviously everything's going up. They're going to outperform, but yesterday they traded very well. I was very surprised.
And one of the guys that I traded with, I did prop trading with, out of Greenwich for years. Him and I were chatting yesterday, and he's like, yeah, man, it's scary, but damn, these cryptos are holding up well, and they really are. I mean, I would have thought over the weekend Bitcoin would have sold off well below 18,000, right?
Yeah.
So anyway, you agree with everything that Steve said, but what are you looking at right now? What do you think is happening?
I wrote, I think, on the chat today. Yeah, I think that this risk reprieve that we're seeing is going to lead to a nice selling opportunity. I think the S&P, if you look at the fibs, probably 39.15, I think is the 23.6 or whatever it is from the big move lower. Anywhere near the 3900s, if we get there, I think it's a very nice selling opportunity, because let's face it. Yeah, there you go. Let's face it. The macro picture hasn't changed yet. It will change eventually, but it hasn't. So I think we're seeing, or we might see a leg like we saw before, heading towards 4,100. I think this leg will probably take us to 39.50-ish or something like that. I'll be looking to sell into that.
I'm not sure, Stelio, that investors will be, again, so naive to extend that leg too much, because the ones that believed in the previous rebound got burned in the fire, right? So
yeah, don't underestimate the buy the dip mentality.
Yeah, but my assumption is that this rebound, if we're getting one from here, is going to be shorter lived than the previous one.
Yeah. All right. Mike said, "Hey, Blake, cryptos are correlated to NASDAQ. Correlations, I would say yes, it's a higher beta move like the NASDAQ, but I would say I would not correlate cryptos to NASDAQ necessarily. I think
what would you correlate them to, Blake?
I mean, I correlate them to risk. I think that if you get a risk bounce, the beta you're going to get on a bounce in Ethereum or Bitcoin or whatever the hell, coin you try to trade is probably the beta is going to be much higher. So it's going to trade like a NASDAQ high beta move, so you're going to get a bigger bang for your buck, trading cryptos on the upside than you are, trading the Dow, let's say. So, okay. Yeah, but I wouldn't draw too tight of a correlation because it's not causation either. So, but those are my thoughts.
Good explanation. Appreciate that.
Yeah. So Ryan, what are you thinking here as far as markets go? What are you thinking about this, where we're at in risk? I mean, some pretty key levels of the market. And I know you talked a little bit this morning about, the sterling, but how do you feel about risk appetite here?
Well, Dale was talking about, looking at long-term horizons, and you were talking about that as well. I'm getting the itch for at least a top in the dollar and perhaps a turn. Just the things that are stacking up. I trade. Look, my real basis of trading is long term. I like looking for the trend changes, and I'm getting that growing feeling. The central bank speakers, what's happening with the pound and the BOE, what's happened with Japan, and we've been speaking about looking for this increased rhetoric in the dollar, but also, we've had the reprice, or we've just gone through the reprice of those Fed dots moving higher. What's it going to take now to get even more hawkish?
Yeah, and I'm glad you brought that up. So yesterday, I forget, we've had so many Fed governors talking, and actually you or Kman probably recognize or realize who it was. There was one of the Fed governors talked about, thinks we might be seeing a top in inflation. Isn't this isn't this what? Well, Stelios, you'd mentioned this earlier, that this year, something you might be looking for. I think, Ryan, you did as well. If we start seeing a top in inflation, or the Fed does, and the Fed starts seeing inflation is peaking, and then we start to see maybe employment data weaken a little bit, this next week, not this Friday, but the following Friday, we start to see employment data come down. Wouldn't that argue that maybe the Fed might say, hey, maybe rates are at highs? And then at the same time, you have a situation where, we're going into wintertime in Europe, and it's gonna, you've got inflationary pressures that are still continuing to mount in Europe and in the UK, and those central banks, whether you're talking about the Bank of England or the European Central Bank, are going to have to be a little bit more hawkish. So we'll get that divergence in monetary policy, where it's really would favor the euro or the sterling over the dollar. I mean, what do you guys think about that as we head into fall?
Well, it's all about picking your poison. If you think the dollar's going to turn, that's one thing. What's it going to really turn against? You've got to think the yen, because purely on how far it's come so far. But then look at the yen side of things. If US starts turning south and everyone else is turning south, these guys are just seeing an economic pickup. If they could be a dead cat bounce and they turn south, so then you're going to get further yen weakness based on the BOJ still easing to oblivion. Do you go against the euro? Well, like you say, the euro's still facing a tough winter and everything going on over there. That's still no reason to buy the euro. So it's all about picking where the best value is. I think maybe
how about Aussie?
Aussie, Kiwi, they could be the ones, maybe over the next few months, or potentially starting next year, are the ones that are really going to see some upside if the dollar starts turning.
I don't disagree with that.
Brett, technically, Blake, those are the only two that haven't taken out their COVID extremes. Every other currency has.
Yeah,
you know what I mean?
As far as the Aussie goes,
that? I mean, look at where
Yeah,
Correct.
that's the generational low right
Yeah.
there. That's the generational low. But the Aussie's really big. I do have some longs here, just so you guys know. I'm picking this up longer term because I am playing this as a weekly chart.
Yeah.
Most of you know this from the week ahead video. I'm playing it like this. So I'm with you, Dale.
So it measures what? It's a 2,400 pip formation. That's big.
Yeah, I mean, from the let's just call it the
Low.
mid 60s to the mid 70s. You're talking about 1,000 pip move just on over the course of like the next couple months. If
I'm saying if we ever break out over 78, that's a huge measured move, isn't it?
It is, and I've sat here for the last couple years, trying to be constructively bullish on the Aussie for the last couple of years. And knowing, well, in my mind, at least, always having the idea that it is going to see parity again up here, and just trying to figure out how it gets up there. And I think this is the way.
Yeah, your answer. Yeah.
This is the way. Hey, Grega is here. Let's hear from Grega a little bit. Good morning, Grega. How are you?
Hey, I'm fine. Thank you.
Good. Hey, what's on your mind? What are you seeing that as far as equities go, maybe currencies? What's got you thinking right now?
Well, I still think that US indexes will clear out those June lows, and that we are headed lower for a wave C decline that we've been tracking for the last few weeks. And at the same time, yes, I agree that US yields are approaching this very massive resistance up there. Like Kman said, 4%. I think that this is a big level. We have 5 waves up on the 10-year US yield. So I think that these cycles could potentially come to an end. But as you know, this is a long process. Some markets will find its top or low earlier than others. But I think that this could be the case by the end of the year, that we will see a shift on this trend. And I think that US dollar index will be trading much lower by the end of the year than current levels.
Okay. Hey, since we haven't heard from you, we haven't heard from you this week, or the last couple of days. What do you make of the cable? And is the cable going lower from here, or do you think that we've found a bottom and this is a false breakdown and below those all-time lows? And
actually, if you will go and to monthly chart, you can actually see that there is a massive big wedge pattern going on down from 2008 highs, 2007 highs. And we are potentially now making a throw over formation, retesting these 1985 lows. So I think that this could be a throw over move, and that actually we could see a reversal. And this kind of a price action reminds me something that has occurred back in 2008, even back then in 2016, 2020. It's the same very strong moves to the downside, but usually cable quite quickly will pick up and stabilize.
So this is the trend line that you're talking about.
That's the lower trend line of the wedge. And if you would connect now 2014, 2021 highs, that would be the upper.
Got it. Okay. Something that looks like this, right?
Yeah, exactly.
Oh, all right. Well, that's interesting. And these would be the 85 lows, and you can see we just took out those lows by just a couple hundred pips. Of course, it happened in Asian trade too. I'm going to ask really quick, just do we have data coming out?
We have durable goods in about 50 seconds.
Let's take a look at that. And then I just want to quickly just ask you guys really quick, is this, and I want to get all your opinions here, is the cable going to see new lows or not? And I think that's a question that a lot of people are asking, right now. So, well, let me move that out of the way. That's the data flash. It comes with ForexAnalytix. I'm just going to put it on 15-minute chart, and boop, and then let's watch this. This is a dollar yen, so we can see what the dollar yen does here. Durable goods orders coming out. Stand by. And just about, well, let me ask you this, Dale. What do you think? Do you think we're done with sterling weakness? Just curious.
Yeah, I think it was a climax.
That was it. That was a capitulation. I thought it was a capitulation too. I Told everybody in the chat room on Sunday night. I thought it was capitulating, but I don't know if I wanted. It's the first time I haven't played a capitulation.
It's such a big range for that capitulation. You still have to pick your spots.
Durable goods orders a little bit better than expected, and we're seeing the dollar respond positively right now. So, okay. So, hey, Ryan, what do you think about this sterling? Is that going to be? Is that it? Was that it?
I don't know. I think that's it. I think it'll be something really needs to crack to hit those lows again. I think 105 is still within range. The thing I do with old levels, when you get blowout moments like that, okay, that was a big low, 1985 low. You got to watch to see if it shows up a second time around. I think that'll be key for what happens. If we test it and hold it again, you've potentially got a bottom in place, and then you got to think about going with it.
Hey,
you watch how it fills out the range, huh?
Yeah, exactly.
I was going to say, you know what to trade against. How about you, Kman? You live in the UK now. What do you think
on the sterling?
Yeah, on the sterling.
Well, I think for now the market we're still in the phase where the people are in a denial phase where they don't trust the government nor the Bank of England, and I think it could last for a little longer for the sterling. But I don't know about the long term. In long term, it could be beneficial for the sterling if they manage to get their funding and stuff under control, and the City of London sees a revival thanks to the company tax breaks. It may turn out being something very good for the sterling in the long term. In the short term, I'm having trouble to really start to buy it right now.
Okay, and Stelios, you always have an opinion about the sterling. So how do you feel about it here?
It's taking a lot of beating. I think we probably have one more final push, but I think what the UK is trying to do here will have probably a good positive effect with years down the line, but there's going to be pain in the short term. So I think probably one more low in sterling before we start being constructive.
All right. Well, I appreciate all your guys' thoughts. Hey, listen, I'm going to give you guys a little bit of information here. The Trader Funding Program is the sponsor of our show, but we have had so many people qualify for live or to trade our money. They have passed their assessments this week because of the volatility, but we've also had plenty of people that actually failed their assessment because of the volatility. So when you're trading and you're doing these assessments, so you can access $1 million account or $500,000 account, make sure you guys are adhering to stops in this. It's a high period of volatility, which is great. It's great for opportunity for everybody to take advantage of, but
double-edged sword.
What's that?
Double-edged sword.
It can be.
Yeah.
So and if you want to learn more about the Trader Funding Program, just watch the 2-minute video down below. It is you basically have to make 10%, not lose more than 5% in a trailing environment. That means the accounts trail to protect everybody's downside. So to learn more about, just watch the 2-minute video down below. I'll put a link in the description for you guys, or in the chat box. I want to thank you all for being here today. And remember, one of the last things I needed to mention, Dale, our prices at the end of the month, end of the quarter, we are going up from 119 a month to 189 for good, because this is first time we're raising prices in 4 years. But we've actually lowered our price to $99 a month. For anybody who wants to take advantage of this last price, you're not going to see this price probably ever again. Is that right, Stelios? I think he took off. I think he had to take off. He did. So anyway, so just want to let you all know that. Make sure you take advantage of it. If anybody jumped in at the 119, you will be retroactively fitted. All right, Dale, it's all yours.
All right, buddy.
Thanks, man.
All right, thanks, team. In quite an environment to have a conversation with you, Jeremy. Welcome back to F.A.C.E.
Thanks for having me, Dale. Good to talk to you. Good to hear all the views on FX markets right before this.
Yeah, FX is the deepest market, and most of the time you don't hear about it, but we started to get some talk about multinationals saying it was a headwind, and these moves in the dollar are historic, what we're looking at here. So, Jeremy, I know you're with Wisdom Tree. Did you want to show some charts today, or just talk with me?
Can I share my screen, or is that or
definitely
your screen?
Yeah.
So I'll pull up my website, which I do have some stuff, and then maybe we can come back to your guys' charts and
well, just you can share your screen by scrolling at the bottom of the box.
Okay.
I know we weren't even using Zoom the last time you and I talked, so it was still GoToMeeting. That was 5 years ago, I think.
Here we go.
Yeah, you're up.
All right, so this is the Wisdom Tree website. We have some great tools as well. We're ETF company. I've been global CIO. I've been with Wisdom Tree 17 years, so one of the regional employees from the firm. I've worked with Jeremy Siegel now for 21 years. Actually, today, it's sort of interesting day, Dale, to be on. Our new edition of Stocks for Long Run is out on Amazon. I've been working with him for 20 years, but this is the first time we're co-authors together on the book. So
congratulations.
Exciting for that. So give that a shout. But
he was a little he was a little apoplectic the other day on CNBC, wasn't he?
Yes. So he made some headlines, and I've been tweeting out to this. So I might as well show one of the key things, where, and this is a chart from the book.
He's too valuable to have his blood pressure go up that far, Jeremy.
I know.
We need him around, so we.
So I'll do a quick thing on the money supply and inflation, why he's all fired up. But this is a chart we show in the book that the long-term trend in money supply was growing 5% a year, and it should grow at 5% a year, which is the money supply translates to real growth in the economy and inflation. So if you think real growth in the economy is 2 to 3% and inflation is 2 to 3%, you should have the money supply grow at a trend of 5%. And so when in the pandemic response, you saw this 5% shoot up 17.5% in 3 to 4 months. This is when he was really starting to be vocal, saying, you're going to start to see inflation. He was on, we do a weekly radio show. So he was telling me that on the show. He was on Barry Ritholtz's podcast, sort of well documented in June of 2020, talking about it. So, 2 years ago, obviously. And then, if you go to the long term, the 70s and 80s, the CPI was 7% a year. Money supply was 9.6. You see in the sort of last 40 years, CPI was 2.5 when money supply was 5. So this goes back to the money supply being 5. And then you scroll down. This is a key data point today. The money supply today, the 4-month change has printed negative. So you almost never have the money supply print negative. Very, very rare. So you saw the post-pandemic response. You see now the 4-month change. So this is going to be the key data you get today. So look at 1 p.m. It's likely to continue to show declines. This is why he says they need to, they don't need to do any more really. But
wasn't there a problem with velocity even before the tapering?
Yeah, I mean that is the sort of formal equation that MV equals PY. So the money supply times velocity is prices times real output. And so there was a declining velocity, but this
exacerbated it.
Yeah, there's this whole question about why is money supply really an indicator? Powell is denying it's an indicator, and we could come back to that. In terms of this big story, and since you guys are focused on currencies, I thought I would pull up, in the ETF world, we do have two baskets. So that's sort of the DXY index. We have a Bloomberg dollar index called USDU, which is a little bit more broader. The DXY is about over 50% euro. This has a little bit less euro, a little bit more everything else. And has a little bit of EM, but not dramatically EM. And the point I was going to make on this, and it ties into sort of Fed versus emerging markets. You were talking about the RAND for a little bit. So this is the longer term chart on the dollar versus EM, but pull into the year-to-date chart, and what you see is, USDU is up about 14.4. CEW is a basket that's only down. I say only, but down half, down 6.8. Which is a testament to these central bankers taking the medicine early. One of the things you could see, there's a field called embedded income yield on our fund pages, and we're using forward contracts to get these currencies. So it's sort of the relative interest rate differential between the Fed and these sort of foreign central banks, and the embedded income yield today, is about 1.6. Could have been higher as the Fed was raising rates, but again, you're getting some catch up in the rest of the world. In CEW, the embedded income yield is your long EM currencies versus the dollar, and yes, the Fed's hiking, but you have a 9% embedded income yield. That's obviously some extreme yields in some of these other countries. Just show the set of countries you're in.
Is it the higher the yield, the higher the risk?
For sure. You've got Brazil, you've got Chile,
yeah.
You've got all these different currencies. But so that, I think it's just an interesting reflection of, you tend to think of what's happening in the pound as, a lot of people were saying this is like an emerging market currency status. The developed are the new EMs, is my sort of buzz line, that
interesting.
The EM currencies are holding up better. The EM currencies are holding up better, half the declines as the developed currencies, because they raise rates sooner, and you get, again, that 9% embedded income yields versus the dollar on an average basis.
Let me ask you this, Jeremy. Were you around long enough to remember things like the Plaza Accord, et cetera?
I mean, I wasn't trading, or I wasn't that wasn't my time, but I heard a lot about it.
Well, BOJ cracked the ice with their intervention last week, right? And we don't know. They're saying there was no intervention in the BOE on the pound collapse, but don't you think we're getting to the point to where it'd be an easy card for the Fed to play, because it's easier to depreciate your currency than to appreciate it? That there would be some type of deal between some central banks for a concerted intervention?
That it wouldn't be in the Fed's interest, though, in many ways. I mean, it'd be in Japan.
Right.
The strong dollar is helping our inflation problems, which is making inflation easier on us. I've been saying, and I've been a big proponent of currency hedging for the developed world. I'm going to just pull up a few more charts on my website to show you a few things on Japan versus, hedged, unhedged.
I mean, why would I want to buy emerging market currencies if I thought this dollar bull run was ad infinitum and continuing to get parabolic to the upside, even though they're holding up better? Don't you need a dollar turn for that really to work?
Yes, and I agree with that. I was just saying, you get a nice embedded income yield. It's just a different dynamic.
The yield is interesting. So yeah, so the yield's interesting, especially even though treasuries have come back to 4%, it's twice that. So okay, what do you think here?
So this is, you talk Japan, so I've been a big proponent for the last 10 years, really, that people should be doing currency hedging when they buy overseas stocks way more than they are. And Japan was a hit product in 2013, 2015. Then people lost interest in the trade. Look what's happening this year. The S&P down 21%, EWJ unhedged Japan down 24%, DXJ currency hedged Japan up 4%. Like, what in the world is going on there? Well, it's partly it's dividends. So we incorporate dividends at Wisdom Tree, and so it's more of a value tilt. So
and we were short the yen.
Well, we're neutral the yen. So we don't. So when you're currency hedged, that is the big story. People say DXJ is long the stock, short the yen. It's short the yen relative to EWJ, because EWJ actually is long the yen. They're long the yen and long the stocks. We're just neutral. We're basically just saying, you want Japanese stocks? We dividend-based Japanese stocks, no yen impact. Now there's a carry trade because Japan has negative rates still, and so we're earning the positive carry too. And obviously you didn't really have much positive carry in the first 9 months, but going forward, we have about a 4% positive carry. Maybe not quite, but you're earning that carry. So the unhedged has to catch up to break even, with that. And so I've been saying people should do this strategically. That they should be much more currency hedged. The dollars had this strong negative correlation between the dollar. Let me pull up that chart because that was a pretty cool piece I also wrote recently on the negative correlation of the dollar to the S&P, and it talks like why, if you're investing overseas, it sort of doesn't make sense to me to speculate on these currencies.
Right. Yeah. God, it's never been more important. Either direction. If the dollar was in a bear market, you still need to know what currency you would have exposure with and which you'd have less. So your view on all the bearishness in the market here, Jeremy?
Well, it's hard for me to have a different tone than the professor. I'm actually in the lead story of the Wall Street Journal today saying we're worried about the Fed over hiking more than necessary was sort of the quote that they're being too aggressive given that money supply dynamics, given all you showed copper coming down 40% from their highs, oil coming down from their highs, the mortgage market at 6.5 to 7%. Real estate is going to come down. There's no question real estate is going to come down, even though CPI is continuing to show real estate prices rising. So that the over hawkishness from the Fed is tough to turn back from. There's a lot of commentary. If they just paused, you're going to get this, that'll be counterproductive to their narrative. It'll lead to more inflation. But real rates.
Well, maybe that wouldn't be. You know what? Let me push back. Maybe that wouldn't be counter to their agenda, because if inflation, which we've been exporting, and the dollar weakens, and we bring some of that back while we give Europe some relief, that would keep prices up, right? Which would be good cover for them to say they want to keep tightening and continue their policy.
It definitely could help the European situation.
It could help the whole globe.
Oh, for sure. I mean, I think there's a lot of truth to that.
So, I mean, don't you think it's a card that I know it's not the Fed's purview on the dollar. I mean, Yellen would have to come out and say something, and it would be under her direction, right? But it seems like an easy card for central planners to use right in here.
Yeah,
just intuition here, Jeremy, because things have gotten disorderly. I mean, we can't walk away from what's happened in the last week or so in currency markets, and the markets could live with it, but business can't.
The thing that I think, if Japan is the center of, there's a lot of people at the center of the storm, but Japan is one that's a notable outlier that they're trying to intervene, but they're not changing their policy. So like if they actually want to have an impact, they need to stop the yield curve control, stop pegging the 10-year at 25 basis points, and let it float with the global interest rates. They don't want to do that. And that's what's pressuring the yen. But they were the highest debt to GDP forever, and people were saying, well, highest debt to GDP, but the lowest interest rates. I mean, that's sort of the fear we have in the U.S. and around the world, is that all this debt's going to lead to much higher interest rates and borrowing. But Japan was the exact opposite, and you wondered why the yen wasn't weaker and why it could hold up despite the Bank of Japan buying all the bonds. And maybe that risk just built up, and that's naturally what you're seeing. And they know there's not much they can do about it. But until they change policy, it's hard to see the yen pressure weak. I think they're gonna have to keep intervening. I don't think it's going to be effective. Not
if it's just them,
right? Or without changing the policy. I don't think the limited interventions is meaningful unless they change those fundamental forces.
Okay. Well, I think the G20's meeting in early October. I don't know if they, maybe market forces will create this correction in the dollar. I think it might take cooperation and something concerted by central banks together to do something. But, like everything, time will tell. How about bonds? At these levels, are you seeing some money flow that want to go in and lock up some of these yields in your ETFs?
So for sure, our top flowing ETF has been USFR, it's floating rate treasuries. People were going to bank loans for the floating rates, but the government issued these treasuries in 2014. We've seen about 6 to 7 billion come into our floating rate treasury product, and it has 1 week duration. So it's been the fund that's floated with the Fed. And so, I think that's the opposite of duration. That's sort of the shortest duration. We are seeing, more conversations around, you're hearing Tina's is done, and you got Terra, that there's now a real alternative. We are talking about in our own, we do a model portfolio business where we're helping be sort of an OCIO type role for advisors. We are having our own conversations. We've been short the benchmark on duration. We're talking more about it. I think our technical people have said 414 is, one of the Fibonacci levels that goes back 15 years, that, if you really still continue to see more path
for the 10-year.
Yeah, for the 10-year.
Okay.
I'd say the real rate move, you started the year with real rates in negative territory, the 10-year tips being negative 1%. You've had over 200 basis points move in that 10-year. You got to like 1.4. I don't have the exact quote in front of me now where we are in the 10-year tips, but as you get 1.5 to 2% from a long-term basis, those real yields we think are above where their long-term rates are. So I would say they're getting more attractive, and that, again, that there is a real alternative there that you can start to earn real income on, and so I do think it's starting to pay to add a little bit more, or at least not be a short duration as we were versus our benchmarks. That's a live conversation we're happening, but the technicals, the technician guys would say you could still have more room for upside. And again, you still haven't seen Japan do anything yet. And so Japan could be one of the other catalysts for even further, movements and rates higher.
Okay. And S&P's, I don't know if you could see my chart. Sure looks like Wile E. Coyote is standing on the ledge here, and we'll see how long it holds. Should get, what do you think? Are we going to finally have that capitulation that never showed up in maybe a volatility products that people trade instead of, do you have anything that people are moving into because of this advance in VIX? It's been pretty disappointing throughout the first 10 months of the bear market, because we've had intense moves, but it hasn't been reflected in the VIX till maybe now.
Yeah, and you can say, like, why is vol compressed? Is it going to get to that 40 level of capitulation? I think so much of the market has been dictated by the bond market. The move index vol was one that was where you saw some of that capitulation. But and now there's also been a ton of option selling programs. I think one of the most successful new ETF lineups has been option-oriented ETFs that's selling calls. So I think that could be one of the things that compresses VIX more structurally. And so perhaps you don't get as high as you did. But yeah, no, I think that we've been talking about that is like, you'd like to see that 40 to 50 VIX real capitulation sell-off, but you haven't seen it. And so I think, it's still all a rates move in my view. Like, even what's happening in crypto, it all comes back to like what's happening in rates driving this sentiment and driving the pressure, and so it's all core. It's all the same trade in so many different ways. And so
do you guys have crypto products? Because it was interesting yesterday, Bitcoin was up with everything else in the red. They're saying it's a crypto winter, so I'd assume there aren't a lot of people, if you have ETFs in Bitcoin.
In Europe,
that's probably slow.
In Europe, they do. In the U.S., the regulators have been slow allowing that type of product in the U.S. But in the European markets, they do have what's called ETPs for Bitcoin, Ether, baskets of crypto. We've seen some interest, but certainly modest. We're definitely having ongoing good conversations with clients, and there's some large family offices who have been watching it and exploring. So I think there is some, there's definitely high engagement around the topic for sure.
Okay. Well, I mean, they're saying, calling it the crypto winter. Isn't there an old Wall Street expression, buy straw hats in winter? I bet I bet Jeremy, I bet he remembers that saying, buy straw hats in winter. So, it's winter, right? In
There you
crypto.
go. There you
All
go.
right. So, very interesting, Jeremy, on your funds that take advantage of currency moves instead of, only hedging it, but it actually enhances the ETF with yield. So,
exactly.
what's the best way for people to, maybe talk to you about it that might be interested in some of the ETFs you mentioned today on the broadcast?
So I showed my Twitter profile, Jeremy D. Schwartz. You can follow me there, send me direct messages if you want to find me there. We also, as you're showing on the website, there's a blog, daily commentary. There's on that strategies page, there's a ton of great content. We have some dashboards. If you go to On the Markets, the top one, the very top link, there's a daily dashboard that gives some of our market charts and views of all that's going on as the top link. The Siegel commentary is there. We get weekly commentary from the professor if you want to stay up to date with him. So you see that the daily market snapshot, you see the weekly market commentary. We're doing a bunch of stuff here. So the On the Markets and then the Insights blogs above also has some other daily commentary. So you could find us. We do office hours similar to this format. We're doing a bunch of those as well. So you can tune into our content there.
What a great place for intelligence gathering. Really,
well,
it was great. It was great talking to you again, Jeremy. Let's keep in touch and touch base in the winter, and maybe by this winter it'll be a crypto spring, and the dollar will be a different story. So really appreciate your giving spirit and coming here, and some very interesting ETFs that you guys have. Appreciate the quality of your work, Jeremy.
Thank you so much for having me.
All right, so that's a wrap, everyone. Jeremy Schwartz, follow him on Twitter at Jeremy D. Schwartz, and go to Wisdom Tree and check out his writings. Dr. Siegel is, let's face it, he's an important voice in the financial markets nowadays, and important to know what they're thinking. So you could join the team in 15 minutes. We'll make it 18 on the Morning Edge. And above all, my friends, my trading warrior brothers and sisters, good hunting today. And remember, don't just count your pips, count your blessings. Adios. And go join the guys in the chat room, because I know there's action happening there right now. Adios.